So if you're listening to this right now, maybe you're commuting or you're just grinding away at your desk trying to get ahead, welcome to the deep dive. We're taking a really close look at a massive stack of sources today, all kind of centered around this incredible book, The Psychology of Money by Morgan Housel.
Right, yeah. And it's such a, I mean, it's a vital topic right now.
It really is, because if you are, an ambitious professional, maybe a recent grad navigating this crazy workforce, or just someone trying to climb that ladder, you are probably so overwhelmed by financial advice that looks like, well, like complex math.
Oh, exactly. It's all spreadsheets and algorithms.
Yeah, totally. Just optimizing every single penny. But today, our mission is to basically take those calculators and just throw them right out the window.
Which is honestly a relief, I think, for most people to hear.
Right, because to get into this, I want you to imagine a certified tech genius, just a guy who, in his 20s, designed and patented these incredibly complex key components for Wi-Fi routers.
Like genuinely brilliant stuff.
Yeah, a certified genius. He started multiple companies, sold them, and was, by every conventional metric of modern capitalism, just wildly successful.
Or dream, basically.
Exactly. So imagine this incredibly educated, high IQ guy standing on a wooden dock overlooking the Pacific Ocean in Los Angeles. He's just hanging out, surrounded by his buddies.
Okay.
And he reaches into his pocket and he pulls out a handful of $1,000 gold coins.
Wait, solid gold coins?
Solid gold, $1,000 coins. And he starts skipping them across the surface of the ocean.
Like rocks.
Literally like skipping rocks. Just side-arming solid gold into the sea. And he's arguing with his friends over whose coin bounced the furthest.
I mean, it sounds like some scene from a movie about, I don't know, Roman emperors just completely losing their minds.
Right.
But it's actually a documented real-world story from our source material today. And it actually gets worse.
Oh, how does it get worse than throwing gold in the ocean?
Well, so a few days after this whole gold coin incident, this exact same tech executive is having dinner in a really nice hotel restaurant. And he accidentally knocks over a lamp, right? And it shatters.
Okay, accidents happen.
Yeah. But the hotel manager comes over and, very politely informs him that the lamp costs $500 and they'll have to add it to his bill.
Seems standard.
Right. But the executive looks at the manager with just pure disgust. He reaches into his pocket and he pulls out a literal brick of cash.
A brick.
A stack of $100 bills, like several inches thick, that he apparently just carried around with him at all times.
That is nuts.
And he peels off $5,000, shoves it into the manager's chest, and he says, here's $5,000, now get out of my face and don't ever insult me like that again.
Wow. I mean, that is just the absolute peak of arrogance.
Yeah, complete unchecked emotional volatility.
Total loss of control. And you really have to ask yourself, when someone is operating with that level of ego, that level of financial invincibility, how long can the math actually protect them?
Right, because he was a genius. He knew how to build these massive companies. He understood complex engineering that most people couldn't even fathom.
But how long does that shield you when your psychology is just that deeply broken?
The answer is, well, it doesn't shield you at all.
Right.
I mean, years later, it came out that this exact tech executive, the guy skipping gold into the Pacific, went completely bankrupt.
Lost everything.
Everything. And the reason we're starting with this story today as we dig into this whole psychology of money concept is because this spectacularly tragic failure perfectly sets up the greatest paradox in the financial world.
Yeah, because right next to the story of this bankrupt tech genius, we have the story of Ronald Read.
Ronald Read. I mean, the man whose life story basically forces every single Wall Street analyst to just look in the mirror and question everything they think they know.
It really does. So let's look at Ronald Read's resume for a second. He was born in rural Vermont. He was the very first person in his entire family to even graduate from high school. And he actually had to hitchhike to campus every day just to attend his classes.
Wow.
And then for 25 years, he fixed cars at a local gas station. After that, he spent 17 years just sweeping floors at a JCPenney.
Just a totally regular working class guy.
Exactly. When he was 38 years old, he bought a small 2-bedroom house for $12,000, and he lived in their exact same house for the rest of his life.
And if you ask his neighbors, what he did for fun, they tell you his main hobby was just chopping firewood.
Chopping firewood. He was the absolute definition of an unassuming blue-collar worker.
Right up until he died in 2014 at the age of 92.
Yeah. And suddenly, this humble firewood chopping janitor is making international headlines.
Which is wild.
It is. Because in 2014, roughly 3 million Americans passed away. Out of those 3 million people, fewer than 4,000 of them died with a net worth of over $8 million.
And Ronald Reed was one of them.
Yes, he died with an $8 million fortune.
And the people who knew him were just completely baffled. I mean, they assumed he must have secretly won the lottery or, maybe inherited some massive estate from a long-lost relative.
Right, because how else does a gas station attendant get $8 million?
Exactly. But when they actually looked into his accounts, there was no secret windfall. There was no lottery ticket. Ronald Reed simply saved whatever small amount he could from his paychecks. He invested those savings into blue-chip stocks. And then, and this is the key, he just waited.
Okay, let's pause right there for a second, because for anyone listening who might not be, super deep into financial jargon, when we say blue chip stocks, what are we actually talking about here?
Oh, that's a really great point to clarify. So a blue chip stock is essentially a share in a massive, well-established, financially sound company.
Okay.
Think of like household names, companies that make toothpaste or tractors or run major banking networks. They aren't the flashy, high-growth tech startups. They're the slow, steady, boring giants that just tend to pay regular dividends and survive economic downturns.
So he wasn't out there, like, finding the next Apple or the next Tesla in his garage.
Not all.
He was buying the most boring, reliable companies imaginable, and he just held on to them for decades.
Right. Through wars, through recessions, political crises, he just let those tiny little investments sit there and compound until they grew into an $8 million mountain.
And he ended up leaving $2 million to his stepkids and $6 million to his local hospital and library.
It's just the contrast is breathtaking.
It's more than breathtaking, honestly. I mean, it completely defies the logic of almost every other profession on Earth.
Well, completely.
Think about this for a second. In what other field, seriously, what other discipline on the planet could someone with zero formal education, zero specialized training, and absolutely zero industry connections massively outperform a highly educated, top-tier professional?
It simply does not happen anywhere else.
Yeah.
I mean, it really doesn't.
It's impossible. Like, you will never, ever read a news story about Ronald Reed performing a quadruple bypass heart surgery with better outcomes than a Harvard-trained cardiovascular surgeon.
No.
You're never going to hear about a gas station attendant sketching out a skyscraper on a diner napkin that turns out to be, structurally superior to a building designed by the world's top architectural firms.
Or a guy who chops firewood for a hobby outperforming top-tier nuclear engineers in designing a reactor.
Exactly. But in finance, in investing in wealth building, it happens. The janitor beat the genius.
And if you want, like, the ultimate proof of this, we just have to look at another figure from our sources today, Richard Fuscone.
Oh, man. Yeah.
Because if Ronald Reed is our humble hero, Richard Fuscone is the exact opposite. Fuscone had a Harvard MBA. He was a top executive at Merrill Lynch.
A heavy hitter.
Oh, yeah. He was so incredibly successful in the high-stakes world of high finance that he retired in his 40s to become a philanthropist. I mean, he was the guy featured on 40 under 40 lists in business magazines.
He literally possessed a master's degree in business administration from Harvard University.
Right.
And he ran operations at one of the largest financial institutions in human history.
Yeah.
He was at the absolute peak of the financial mountain.
He was. And so in the mid-2000s, he decides to expand his home in Connecticut. And he borrowed heavily, taking on just massive amounts of debt to expand this house into an 18,000 square foot mega mansion.
18,000 square feet.
Yeah. It had 2 elevators, 2 swimming pools, 7 garages. I mean, the monthly maintenance costs alone would completely bankrupt a normal person.
So he is highly leveraged here. He has tied up enormous amounts of money in a very illiquid asset,
Yes,
like a giant house that you can't just sell overnight if you suddenly need cash.
precisely. And then the 2008 financial crisis hits.
Right.
The housing market collapses, the stock market plummets, and Fuscone's liquid assets, the cash and easily sellable stocks he actually had, they just evaporated or were totally locked up.
So he couldn't service the debt?
He couldn't service the massive debt on that 18,000 square foot mansion. The math just stopped working, and the Harvard MBA, the Merrill Lynch executive, had to declare bankruptcy.
Wow.
A judge literally ordered his home to be sold in foreclosure for a fraction of what he owed.
So the Harvard MBA goes bankrupt and the JCPenney janitor becomes an $8 million philanthropist,
Exactly.
which really brings us to the core thesis of everything we are unpacking today. Because if you are commuting right now or you're grinding away at a desk trying to figure out how to get ahead in your career or your life, you are probably bombarded with advice that looks like complex math.
Always. Spreadsheets, ROI calculations, optimization algorithms.
But the Fuscone and Reed story proves that finance is not a hard science.
No, it's not.
It is not physics. It is not governed by strict immutable laws where, a certain mass applied to a certain force equals a perfectly predictable outcome every single time.
It is a soft skill. Building wealth and managing a career are governed by human behavior, by ego, by jealousy, by pride, by insecurity, and, honestly, by our own personal histories.
So true.
The core premise here is that doing well with money has very little to do with how smart you are, and it has almost everything to do with how you behave. And behavior is notoriously hard to teach, even to incredibly intelligent people.
So we really have to just throw the calculators out the window for a moment. To understand how to actually apply this to our own lives,
Yeah.
we have to examine the invisible architecture of our choices.
Right.
Like, why do we make the decisions we make? Why do incredibly smart people take on massive, ruinous debt? Why do we panic? Which brings us to this psychological concept from the sources that I think completely reframes how we judge ourselves and how we judge everyone around us.
Yeah, it's the idea that no one is crazy.
Right. And, I mean, on the surface, that sounds like a platitude.
Yeah.
Because people do incredibly crazy things with their money and their careers all the time.
Oh, absolutely.
Taking out a massive mortgage on a house with 2 elevators right before a global recession seems objectively crazy. Skipping gold coins into the ocean is crazy.
It looks crazy from your vantage point right now with the information you currently have.
Yeah.
But the research points to a really profound biological and psychological truth.
Which is?
Your personal experiences with money, your specific life events, they make up maybe 0.0000001% of what has actually happened in the world. But those tiny, highly specific personal experiences dictate 80% of how you think the world works.
Wow. Think about what that actually means for a second. A fraction of a percent of history is responsible for 80% of my worldview.
We are all just walking around anchored to our own microscopic sliver of reality.
There is this analogy I read recently that I think captures this perfectly.
Mhm.
Imagine you are trying to navigate a sprawling, modern, bustling city. Let's say it's 2026,
Sure.
but the only tool you have is a street map that was hand-drawn by your parents 30 years ago. Now, it's not that your parents were stupid when they drew the map. The map was perfectly accurate for the reality they lived in. But the city has evolved, right? Rivers have been rerouted. Massive skyscrapers have been built. Old highways have been completely torn down.
Right.
If you try to drive through the city today using that 30-year-old map, you are going to crash into a brick wall, or you're going to drive your car straight into a newly dug canal.
And when people standing on the sidewalk watch you drive your car into a canal, they're going to point at you and say, look at that crazy person. Why would they drive into the water?
Exactly. But from my perspective, sitting in the driver's seat, looking down at my map, I'm not crazy. I'm making a perfectly rational decision based on the information I was given. I'm following the road exactly as I understand it.
And this plays out across generations in such fascinating ways.
Yeah.
Especially regarding how our brains wire themselves during early adulthood.
How so?
Well, neuroplasticity is highest when we're young, right? So the things we experience in our late teens and early 20s form these permanent psychological grooves in our minds. Let's take the stock market as an example. Imagine a person born in 1970.
Okay.
During their formative years, their teens and 20s, the S&P 500 increased almost tenfold, adjusted for inflation.
So their brain is literally wiring itself to understand risk and reward while watching the stock market act like this magical ATM that just never runs out of cash.
Exactly.
Every time they put money in, it grows. Every dip instantly recovers.
So their internal map says, the stock market is a safe, wealth-generating machine. Risk is heavily rewarded.
Right.
Now, contrast that with someone born in 1950. During their teens and 20s, the stock market went literally nowhere.
Nowhere.
Adjusted for inflation,
Right.
it's completely stagnant. It was flat for years and years.
Man. So their map says, the stock market is a rigged casino. It's a trap. The only safe place for money is under a mattress or in a boring savings account.
Right. And what happens when these two people meet at a dinner party, or they sit across from each other in a financial planner's office, and they try to agree on an investment strategy?
Oh, it's going to be a disaster.
The 1970 baby wants to push all their chips into index funds. The 1950 baby wants to buy gold and hoard cash. And they look at each other, and they both think the other person is entirely certifiably crazy.
But neither of them is crazy.
No, they were just shaped by different, equally persuasive historical realities.
And, you see this incredibly clearly with inflation, too. Like, if you grew up in the 1960s, you entered adulthood in the 1970s, which was a period of just brutal double-digit inflation.
Oh, yeah.
And I really want to emphasize what that actually feels like, because it's not just a number on a spreadsheet.
No, it's visceral.
Imagine you spend 5 years grinding at your job, saving up $10,000, you put it in the bank, and then inflation hits 13%.
It just eats it away.
Every single year, your hard-earned savings lose over a tenth of their buying power. The cost of groceries doubles. There are literally lines at the gas station. You go to buy a house, and the mortgage interest rate is 18%.
Unthinkable today.
The money you sacrifice to save is actively dying in your bank account. That creates a real trauma, a financial scar.
It rewired your nervous system. You learn that saving cash is for absolute fools because cash evaporates. You learn you have to spend it immediately or buy hard assets.
Right. But then you take that person and you have them give financial advice to a 25-year-old today who was born in the late 1990s.
Right.
That 25-year-old has lived their entire cognitive life in an era of incredibly low, stable inflation. The monster of inflation has never been hiding under their bed. So when the older generation screams, "You have to hedge against inflation, buy gold, don't hold cash," the younger person just rolls their eyes.
And you cannot read your way out of this psychological trap.
What do you mean?
You can read 100 books about the Great Depression. You can study the intricate spreadsheets of the 1929 crash. But you do not have the emotional scars. You cannot model the sheer, visceral terror of coming home from work, looking at your children at the dinner table, and wondering if the global economy just permanently destroyed their future.
Right.
As the investor Michael Batnick notes in the sources, some lessons have to be experienced before they can be understood.
That's a great quote. We are all just stumbling around with these outdated maps, reacting to our own highly specific historical trauma.
Exactly.
And that realization opens the door to something even more uncomfortable, I think. Because if our worldview is shaped by the random era we happen to be born in, it forces us to confront the two siblings that dictate almost everything in life, but that nobody wants to talk about.
Luck and risk.
Luck and risk. They are the ultimate taboos, especially in a culture that just worships the self-made billionaire.
Oh, absolutely. The sources dive deep into the story of Bill Gates to illustrate this. And it is a brilliant dissection because the narrative we are always fed is just about his raw, unadulterated genius.
Right, the myth of the lone genius.
Exactly. He was smart, he worked hard, he built Microsoft. End of story. But when you look at the actual mechanics of his youth, the luck component is staggering.
It really is. Like, let's look at the year 1968. There were roughly 300 million high school-age people in the world.
300 million.
Of those 300 million, only about 300 attended a small private school in Seattle called Lakeside.
Okay.
Now, Lakeside happened to be essentially the only high school in the entire world at that time that had a computer.
Let that sink in.
And not just any computer, it was a Teletype Model 30 connected directly to a mainframe.
Right. And to put that into perspective for a listener today, having a computer in 1968 wasn't like having a laptop in a classroom.
No, not at all.
Computers were the size of entire rooms. They cost hundreds of thousands of dollars. Universities barely had them. But Lakeside had this visionary teacher who used the proceeds from a school rummage sale to lease time on this machine.
A rummage sale.
Yeah. And computer time was incredibly expensive. It cost dollars per minute, which was an absolute fortune back then. But because Bill Gates went to Lakeside, an 8th grader had unlimited, unfettered access to a piece of technology that 99.999% of the global population didn't even know existed.
So mathematically, out of 300 million kids, Bill Gates was one of 300 who had this access. That is a 1 in a million stroke of pure, unadulterated luck.
He was a genius, yes.
Yeah.
He worked incredibly hard. He had the vision to understand what computers would become. But even Gates himself admits that the environment provided this spark. I mean, he has explicitly stated, if there had been no Lakeside, there would have been no Microsoft.
But the story of Lakeside has a darker half, doesn't it? Because luck has a doppelganger. Right. There was actually a third member of this teenage computing group. We all know Bill Gates, and we all know his co-founder, Paul Allen.
Right.
But there was another kid at Lakeside who was right there in the computer room with them, a kid named Kent Evans.
Kent Evans was widely considered to be just as smart, just as driven and just as visionary as Bill Gates. Bill Gates has recounted how he and Kent would stay up late on the phone, plotting out their future, figuring out exactly how they were going to start a company and change the world.
Wow.
Kent Evans had the exact same one-in-a-million luck of attending Lakeside. He could very well have been a founding partner of Microsoft.
But Kent Evans didn't start Microsoft. He isn't a billionaire.
No,
Yeah.
because before he even graduated high school, Kent Evans died in a mountaineering accident.
Oh, man.
Now, the odds of a high school student dying on a mountain are roughly 1 in a million. Bill Gates experienced a 1 in a million stroke of pure compounding luck. Kent Evans experienced a 1 in a million stroke of pure compounding luck. Kent Evans experienced a 1 in a million stroke of pure ruinous risk.
That's devastating.
They were playing on the exact same field with the exact same skills, the exact same work ethic, and the external forces of the universe just flipped a coin.
You know, I'm struggling with this part, honestly.
How's that?
If I put myself in the shoes of someone listening to this right now, someone who is commuting, grinding 60 hours a week, dealing with a micromanaging boss, trying to pay off high-interest student loans, desperately trying to build a portfolio so they can afford to just buy a starter house.
Right.
If you were telling me that ultimate success or failure is just a cosmic coin flip between lakeside computer luck and a mountaineering accident, then why am I trying so hard?
I hear you.
Like, does my effort actually matter? Because if it's all just dumb luck, that is a deeply depressing, kind of nihilistic reason to just give up.
And that is exactly why people hate talking about luck. They assume acknowledging luck means erasing effort. They think it invalidates their hard work. But that is fundamentally misreading the situation.
Okay, walk me through that.
The nuanced takeaway here, the reason the sources focus so heavily on this, is not that effort doesn't matter. It's the realization that nothing is as good or as bad as it seems.
How does acknowledging that luck and risk are in the driver's seat actually help me navigate my career, though?
Because it stops you from blindly imitating the extreme outliers. When you judge someone's massive success, or when you judge your own crushing failure, you have to realize you are looking at the final result of a million moving parts, many of which were entirely out of anyone's control. Let's look at John D. Rockefeller.
The oil tycoon.
Yes. Rockefeller routinely and brazenly bypassed the law to build his Standard Oil monopoly. He made secret deals with railroads. He crushed competitors using tactics that were highly questionable, if not outright illegal.
Just totally ruthless.
A judge at the time once called his company no better than a common thief.
Wow.
But history, by and large, remembers him as a cunning business genius. The narrative is always, Rockefeller was a visionary. He didn't let outdated bureaucratic laws get in the way of innovation.
Right. We praise his ruthlessness as the key to his success.
But think about how razor-thin that line is. How little would the winds of luck have to shift for a slightly more aggressive prosecutor to have him arrested?
Oh, I see.
If Rockefeller had gone to prison, history would remember him as a reckless criminal. The narrative would be, Rockefeller was a crook. Learn from his failures. Don't break the law. It is the exact same behavior, the exact same decisions, just a slightly different roll of the risk-luck dice.
Okay, I see where this is going. If we don't acknowledge the massive amount of luck that kept Rockefeller out of a jail cell, we look at his rule breaking and we say, aha, that's the secret. To be a billionaire, I need to be a ruthless rule breaker.
Exactly.
We try to emulate reckless behavior, thinking it is pure genius, and then we are absolutely shocked when we end up bankrupt or fired or in jail.
The line between inspiringly bold and foolishly reckless is a millimeter thick, and it is usually only visible with the benefit of hindsight.
That makes a lot of sense.
If you ignore the role of luck, you will waste your life trying to perfectly copy the billionaire outliers.
Yeah.
You will wake up at 4 a.m. because some eccentric CEO does it. You will take on massive debt because a real estate mogul did it. And you will adopt all of their risks without having access to their specific luck.
And, I mean, the inverse is true as well, which is incredibly freeing, right? This entirely changes how we process our own failures.
Profoundly. When you hit a wall in your career, when you launch a product that fails or an investment tanks despite you doing all the right research, if you ignore the concept of risk, you assume the failure is a reflection of your inherent worth.
You think, I am stupid, I am incompetent.
Right. But if you deeply respect the reality of risk, you can give yourself grace. You can look at the situation and say, I made a sound, reasonable decision based on the information I had at the time, but the world is complex and I ended up on the wrong side of the risk probability this time.
It prevents a bad outcome from destroying your identity. It gives you the psychological resilience to not internalize a bad outcome as a fatal character flaw. So, for the listener commuting to that 60-hour-a-week job right now, the tactical takeaway here is a massive shift in focus.
Yes.
Stop obsessing over the extreme outliers. Stop dissecting exactly what Elon Musk or Warren Buffett did on a specific Tuesday to get rich, because you cannot replicate their specific intersection of luck and timing.
You literally can't.
Instead, look for broad, repeatable patterns of survival. Find the habits that simply allow people to stay in the game. Protect yourself from ruinous risk, the kind of risk that takes you off the board entirely, so that you can survive long enough for your own luck to finally hit.
Survival. That is the perfect pivot point here. Because getting to the top of the mountain is one skill set, but staying on top of the mountain without freezing to death is an entirely different biological mechanism.
Which brings us to the second major framework from the sources, the secret engine of success. The massive glaring difference between getting wealthy and staying wealthy. And I'll frame it like this. What if the secret to building massive generational wealth has almost nothing to do with making brilliant, aggressive 3D chess decisions and absolutely everything to do with consistently, boringly not screwing up?
It is the least sexy advice in the financial world, and it is mathematically the most accurate.
So true.
Getting money and keeping money require two completely different, almost diametrically opposed mindsets.
Because getting money requires taking risks. It requires being wildly optimistic. You have to put yourself out there. You have to bet on yourself. You have to believe that your startup idea will work when everyone says it won't. You need ego.
But keeping money, staying wealthy, that requires the exact opposite.
Yeah.
It requires a baseline level of paranoia. It requires frugality. It requires a deep, abiding fear that everything you've built could be taken away by a random market crash tomorrow.
Paranoia as a financial tool.
Absolutely. And above all, it requires the humility to admit that your past success was at least partly due to luck, which means you cannot rely on simply repeating your past aggressive moves forever.
Let's go back to 1929 for a historical masterclass on this exact whiplash.
The Great Crash of 1929, the event that kicked off the Great Depression. We have two very different characters here, Jesse Livermore and Abraham Szymanski.
Okay, set the stage for us.
Jesse Livermore was arguably the greatest stock market trader of his day. He was a legend. During the 1929 crash, while the market was losing a third of its value in a matter of days and the entire global economy was plunging into chaos, Jesse Livermore was shorting the market.
Okay, before we go further, for someone who isn't, a day trader, what exactly does it mean to short the market in 1929?
Great question. When you buy a stock normally, you want the price to go up. But when you short a stock, you are betting that the price will crash.
Right.
Mechanically, you borrow shares of a stock from someone else, sell them immediately at today's high price, and put that cash in your pocket. Then you wait.
And hope it crashes.
Right. If the stock price crashes, you buy those same shares back at the new dirt cheap price, return them to the person you borrowed them from, and you keep the difference as pure profit.
But the risk is that if the stock price goes up instead of down, you still have to buy the shares back eventually to return them.
Exactly.
And there is no limit to how high a stock price can go, which means your potential losses are theoretically infinite.
It is an incredibly aggressive, high-risk maneuver. But Livermore saw the crash coming. He shorted the market heavily. And when the dust settled in October 1929, while the rest of Wall Street was ruined, Livermore walked away with a fortune equivalent to $100 million in today's money.
Man, he made the ultimate, brilliant, aggressive move.
He mastered the art of getting wealthy. And on the other side of the spectrum, we have Abraham Szymanski.
Right. Who was he?
Szymanski was a multimillionaire real estate developer. He had made a fortune in the booming 1920s, but he was heavily, aggressively invested in stocks. And he used a lot of leverage, meaning he borrowed money to buy those stocks.
Oh, no.
Yeah. When the 1929 crash hit, the banks issued margin calls.
Meaning the banks called him up and said, the stocks you bought with our money are worthless now. Give us our cash back immediately.
Yes. And he didn't have it. His fortune was wiped out in a matter of hours. Szymanski was last seen walking down Wall Street in a daze, tearing ticker tape into tiny pieces.
Yeah.
He disappeared and was entirely ruined.
So in 1929, we have total opposites. Livermore wins $100 million. Szymanski loses everything.
But the story doesn't end in 1929.
No.
Fast forward just 4 years to 1933. Jesse Livermore is overflowing with confidence from his massive win. He feels invincible. He thinks he can read the matrix of the market perfectly, so he starts making larger, increasingly reckless bets.
Oh boy.
He uses massive leverage. He abandons the caution that should follow a massive win, and the market turns against him.
He loses it.
He loses everything. His entire $100 million fortune evaporates. He goes completely bankrupt, vanishes for 2 days, and eventually takes his own life.
Wow. So, despite the timing being different, Germansky and Livermore ended up sharing the exact same fatal flaw.
They were absolute geniuses at getting wealthy and completely incompetent at staying wealthy. Livermore thought his 1929 success was 100% pure skill. He didn't respect the risk. He didn't have the paranoia required to protect what he had built.
And this brings us to what the sources called the invisible architecture of compounding. To understand how to actually keep wealth growing, there's this phenomenal analogy in the text about geology, specifically the ice ages.
Oh, I love this concept.
It's so good.
It's one of the most elegant ways to explain compounding I've ever seen. For a long time, scientists couldn't figure out what caused ice ages. Did the Earth's orbit shift drastically? Was there an unbelievably brutal apocalyptic winter that just instantly froze the globe?
Right, because you naturally assume it has to be a catastrophic event to cause a catastrophic change.
Exactly. But it turns out the catalyst for an ice age isn't an extreme event at all. The trigger is remarkably subtle. It is just a moderately cool summer.
A cool summer, not a freezing winter.
A moderately cool summer. Here is the mechanical breakdown of how a planet freezes. You have a normal winter, snow falls. But then the summer that follows isn't quite as hot as usual.
Okay.
It's just cool enough that a tiny thin layer of snow fails to melt. It survives the summer months. So when the next winter rolls around, the new snow falls on top of that surviving layer of old snow. This makes it slightly easier for snow to accumulate.
Right.
And here is the crucial part. Snow is highly reflective. A larger surface area of white snow reflects more of the sun's radiation back into space, which means the Earth absorbs less heat.
Which means the Earth cools down just a tiny fraction of a degree more.
Exactly. It's a feedback loop.
Oof.
Because the Earth is slightly cooler, the next summer is even cooler than the last. So an even thicker layer of snow survives, which reflects even more sunlight, which cools the Earth further. Until literally within a blink of geological time, a thin layer of surviving snow compounds into continental ice sheets that are miles thick. A glaciologist named Gwen Schultz summarized it perfectly. It is not necessarily the amount of snow that causes ice sheets, but the fact that snow, however little, lasts.
The snow just has to last. It doesn't have to be a blizzard. It just has to survive the summer.
That is the biological essence of compounding. You do not need tremendous aggressive force to create tremendous world-altering results. You just need a tiny bit of grape to stick around, to not melt away during a market crash or a bad career move, so it can serve as the foundational base for the next tiny bit of growth.
And if we want to talk about human ice sheets, we have to talk about the grandfather of all compounding stories, Warren Buffett.
Of course.
We all conceptually know that Buffett is incredibly wealthy, but the sources break down the actual math of his wealth in a way that feels almost fake.
It breaks our brains because human beings are entirely incapable of intuitive exponential math. We think linearly, 1, 2, 3, 4. We don't naturally think 1, 2, 4, 8, 16. At the time the source material was written, Warren Buffett's net worth was $84.5 billion. Now, if I were to ask a random person on the street how much of that fortune he earned before his 50th birthday, they'd probably say, well, he's a genius, so maybe half of it.
Right. You assume he made $40 billion in his youth and $40 billion in his old age.
Out of $84.5 billion, he earned $84.2 billion after his 50th birthday.
That is absurd.
Let me make it more absurd.
Yeah.
Out of that $84.5 billion, $81.5 billion came after he qualified for Social Security in his mid-60s.
Wait, meaning $81.5 billion of his wealth was generated during the years when most human beings are retired and, like, playing golf?
Yes. Every year, 100 new books are published trying to decode exactly how Warren Buffett analyzes a balance sheet. They analyze his management style, his value investing metrics, his negotiation tactics.
Everyone wants the secret sauce.
But his true, ultimate secret isn't that he is the greatest stock picker of all time. His secret is that he started investing when he was 10 years old, and he never stopped. He's been investing for 3/4 of a century. He just let the snow accumulate. He never let it melt.
To prove how vital that timeline is, the sources offer a counterexample that blew my mind. Jim Simons.
Yeah, Jim Simons, the mathematician who founded the hedge fund Renaissance Technologies.
Right?
Jim Simons has compounded money at roughly 66% annually since 1988. Warren Buffett compounds at roughly 22% annually. Mathematically speaking, Simons is earning 3 times the annual return of Buffett. He's a far superior investor in terms of sheer percentage growth.
66% a year is borderline science fiction. So logically, Jim Simons must be the wealthiest entity in the known universe.
Jim Simons' net worth is about 75% less than Warren Buffett's. He's worth around $21 billion compared to Buffett's $84 billion.
How is that even mathematically possible? If his returns are 3 times higher, how does he have a fraction of the money?
Because Jim Simons didn't find his investment stride until he was 50 years old. He has had less than half as many years to compound as Buffett.
Wow.
The source actually calculates this, and it is the most staggering statistic in the entire deep dive. If Jim Simons had earned his 66% annual return for the exact same 70-year time span that Buffett has been investing, his net worth today wouldn't be $21 billion.
What would it be?
It would be 63 quintillion. $900 quadrillion.
Which is, wait, is that more money than exists?
It is vastly more money than exists on planet Earth.
That is wild.
The point is, time is a dominant variable in the equation. Not intelligence, not aggressive risk-taking. Time. And time only works its magic if you survive.
If you don't interrupt the compounding.
Right. If you don't panic and sell your entire portfolio during a recession, if you don't leverage yourself so heavily with debt that a margin call forces you out of the game entirely, Warren Buffett survived 14 recessions without panic selling. He survived.
Okay, I have to step in here. Because the math is undeniable. The snow analogy makes perfect logical sense. Right.
But I want to advocate for the listener who is sitting in traffic right now, gripping the steering wheel. Let's look at their reality. I am young. I have student loans with a 7% interest rate. I am trying to scrape together a down payment for a house while real estate prices are shooting up 15% a year.
That's tough.
I want results now because I feel like I am falling behind. If you tell me the secret is to hold cash, be paranoid, and just shut up and wait for 50 years, it feels like terrible advice. Because holding cash when inflation is high feels like I am actively losing money every single day. How is shut up and wait practical advice for someone in their 20s or 30s who is just trying to establish a foundation?
That is a completely rational, incredibly common feel.
Yeah.
And it is psychologically painful.
Yeah, it really is.
Holding a large cash emergency fund during a booming bull market feels like you are bleeding out from opportunity cost. If your cash is sitting in a savings account earning 1% and the S&P 500 is returning 10%, that 9% gap just eats at your soul.
Yeah. You look at your peers getting rich on crypto or tech stocks, and you feel like a coward for holding cash. But this is where we have to fundamentally redefine what a margin of safety or room for error actually means in the real world.
Okay, tell me how to rationalize hoarding cash when everything in my body wants to be investing it to beat inflation.
You have to calculate the hidden return on that cash, the return that doesn't show up on a spreadsheet. Let's say a brutal bear market hits. Stocks drop 30%.
Okay.
At the exact same time, you lose your job, or your car transmission blows up, or you have a massive unexpected medical emergency. If you do not have that paranoid cushion of cash, what are you forced to do?
I guess I'd have to sell my investments.
You are forced to sell your stocks to pay your rent. And because the market is down, you are selling them at the absolute bottom, locking in massive permanent losses and completely halting your compounding engine.
Because I literally have no other choice. I have to eat.
Exactly. But if you have that cash, that boring, unsexy cash that was earning a measly 1%, it serves as a firewall. It prevents you from having to desperately liquidate your investments.
Yeah.
Because it prevented that ruinous sale, the actual ROI, the true return on investment of that cash, isn't 1%. It is astronomical. It could be many multiples of what you would have earned in the market because it kept your compounding engine running in the background.
Wow, I never thought of it like that.
Room for error isn't just about being conservative. It is about mathematically raising the odds of success by guaranteeing survival when the inevitable bad luck hits.
And surviving the bad luck means you actually get to stick around long enough to experience the tail events.
Yes. Tail events drive everything. In finance, in business, in art, in life. A tiny, extreme minority of events account for the vast majority of outcomes.
Right.
If you are a brilliant business leader, maybe half of your ideas will actually work. The absolute best stock pickers in the world are right maybe 60% of the time. You do not have to be perfect. You can be wrong half the time and still make an absolute fortune as long as you survive your mistakes.
Sources use Amazon as the ultimate corporate example of this, right?
It's the perfect example. We look at Amazon today and we just see an unstoppable trillion-dollar juggernaut. Yeah. But do you remember the Amazon Fire Phone?
Oh, the Fire Phone. It was an absolute disaster. I think they had to write off hundreds of millions of dollars.
It was a catastrophic failure.
Mm.
A multi-hundred-million-dollar bonfire of capital. It intuitively seems like a CEO should be fired for a product launch that is disastrous.
Yeah, heads usually roll for that kind of thing.
But shortly after that happened, Jeff Bezos was asked about it, and he basically laughed and said, if you think that's a big failure, we are working on much bigger failures right now.
Why would he say that?
Because Bezos understands that tails drive everything. The Fire Phone failed miserably, but around the same time, they launched Amazon Prime and Amazon Web Services AWS.
Right.
Those were tail events. They were such extreme, unbelievable successes that they didn't just cover the cost of the Fire Phone, they drove the entire valuation of the company. You just have to have enough cash and enough margin of safety to survive the Fire Phones of your life so you can be around for the AWS.
You just have to be on the playing field when the 1% of decisions that actually matter finally happen. So here's the tactical exit for this framework. The sources suggest you need to barbell your life.
Barbell it. Yes.
Imagine a weightlifting barbell. On one extreme end of the barbell, you need to be intensely paranoid. Hoard your emergency fund, be incredibly conservative with debt, protect your foundation so that a sudden shock of layoff, a medical bill doesn't wipe you out.
Right.
But on the other extreme end of the barbell, once that safety net is secured, take bold risks. Take the weird startup job, launch the side hustle, invest a portion of your money in aggressive assets. Be unbreakable first and ambitious second. Because if you are unbreakable, you can survive enough failures to eventually hit your tail event.
Unbreakable first, ambitious second. It is the only way the math of compounding actually works in reality. And that leads us perfectly into the final major framework here. Because let's say you follow this advice, you survive, you compound, you start making some real money. The ultimate trap is what you decide to do with it.
Which brings us to the true currency of this entire philosophy: ego, invisible wealth, and time. If you are listening to this, think about everything society, Instagram, and your peers are telling you about what it means to look successful.
Right.
What if following that exact blueprint is actually a step-by-step guarantee that you will be trapped in the rat race forever?
It is the ultimate paradox of modern consumer capitalism. We have entire trillion-dollar industries dedicated to helping people fake it until they make it. And participating in that signaling completely destroys their ability to actually make it.
The sources introduce a concept called the man-in-the-car paradox. Walk us through what that means.
Okay, so the author recounts his time working as a valet at a high-end luxury hotel in Los Angeles. Every day, he'd see people roll up in Ferraris, Lamborghinis, Rolls-Royces. And as a young guy, he'd look at these magnificent cars and think, wow, if I had that Ferrari, people would think I'm smart. They'd think I'm rich. They'd respect me. Look at me.
Sure, that's natural.
But then he had this profound realization. When he looked at a Ferrari driving down the street, he never, ever gave a single thought to the driver.
He didn't look at the guy behind the wheel and think, wow, what a brilliant, hardworking man.
No. He looked at the car and thought, wow, if I were in that driver's seat, people would think I was cool.
Oh, that's so true.
The paradox is that people buy wealth-signaling items,
Yeah.
luxury cars, massive watches, designer clothes, because they deeply want respect and admiration from others. But others don't use those items to admire the owner. They use those items as a benchmark for their own desire for admiration. No one is as impressed with your possessions as you are.
And it creates this incredibly dangerous optical illusion about what wealth actually is. When you are sitting at a stoplight and a guy pulls up next to you in a $100,000 Porsche, your brain instantly assumes that guy is rich.
But you have absolutely zero empirical evidence that he is wealthy. The only factual data point you have when you see someone driving a $100,000 car is that they either have $100,000 less in their bank account than they did yesterday, or they are $100,000 in debt. That's it. That is the only math you can verify.
Wealth is what you don't see.
Yes. Wealth is the $100,000 car that was not purchased. It is the first-class upgrade declined. It's the Rolex left in the display case. We constantly confuse the concept of being rich with being wealthy.
That's the difference, really.
Being rich simply means you have a high current income. You make enough money to afford the $1,500 monthly lease payment on the Porsche, but wealth is hidden. Wealth is income not spent. It is an option not yet taken.
There's an analogy in the sources about diet and exercise that I think perfectly nails why this is so psychologically difficult for us. The author Bill Bryson writes about how human beings drastically overestimate how many calories they burn during a workout. You spend 30 minutes on a treadmill, you feel exhausted, and your brain tells you that you just burned 1,000 calories. So you reward yourself by eating a massive slice of cake that contains twice as many calories as you just burned.
And you end up gaining weight while feeling like you were working hard.
Exactly. Building wealth operates on the exact same psychological mechanism. You grind at your job, you get a promotion, you get a 15% raise, you feel like you did the work, so your brain says you deserve a reward.
Naturally.
You buy the fancy car, or you upgrade to the luxury apartment with the rooftop pool, or you start taking 5-star vacations. Working out and then immediately eating a massive cake is the exact equivalent of getting a raise and immediately inflating your lifestyle to match your new income.
You are undoing all the progress. You are running on a financial treadmill, but increasing the speed every time you get stronger. Wealth is turning down the treat meal. Wealth is the financial calories you didn't consume. And it requires incredible, painful self-control because you are actively suppressing your ego. You are denying yourself what you could easily buy today.
There is a hilarious but deeply tragic quote from the sources regarding the pop star Rihanna. At one point in her career, despite making millions of dollars, she nearly went bankrupt because she was just hemorrhaging cash on real estate, cars, and lifestyle.
Yeah.
She actually tried to sue her financial advisor for mismanaging her money. And the advisor's response in court was brutally simple. He basically said, was it really necessary to tell her that if you spend money on things, you will end up with the things and not the money?
I mean, it sounds like a punchline, but it is a fundamental truth that most of us ignore. People say, I want to be a millionaire, but what they usually mean is, I want to spend $1 million, which is literally the mathematical opposite of being a millionaire.
So true.
Saving money isn't an accounting trick. Saving money is simply the gap between your ego and your income.
Okay, I am going to push back here because I'm looking at my own life and I'm looking at my peers on Instagram. Everyone is taking trips to Tulum, buying the Tesla, upgrading the kitchen.
It's everywhere.
If the definition of wealth is what you don't see, if wealth is the car I don't buy, the vacation I don't take, the nice dinner I turn down, what is the point?
Right.
Am I just supposed to live like a monk in a cave? Am I supposed to just stare at a growing Vanguard index fund balance that I'm never allowed to touch until I'm 80 years old? Because if I can't spend the money to actually enjoy my youth, why am I grinding 60 hours a week in the first place? It feels like a prison of my own making.
That is the ultimate existential question of personal finance. And it brings us to the highest realization of this entire deep dive, the absolute pinnacle of the psychology of money.
What is it?
Money's greatest intrinsic value, the highest dividend it pays, is not its ability to buy stuff. It is its ability to buy time.
Buying time.
Let's look at the hard psychology research. The sources reference Angus Campbell, a renowned psychologist from the University of Michigan. He conducted massive, sweeping studies on what actually makes human beings happy.
Okay.
He looked across all income brackets, geographies, and education levels. And he found that the most dependable, universal predictor of human happiness is not the square footage of your house. It is not the prestige of your job title. It's not even your raw income. It is having a strong, abiding sense of controlling your own life.
Autonomy. Controlling your time.
Yes. Campbell summarized it perfectly. Having a strong sense of controlling one's life is a more dependable predictor of positive feelings of well-being than any of the objective conditions of life we have considered. The ability to do what you want, when you want, with who you want, for as long as you want. That is the highest return on investment money can provide.
Think about what that means for a young professional right now. We live in a hyper-competitive, globally connected world. If your career strategy is based entirely on the premise, I am smart, therefore I will succeed, you are in deep trouble.
Oh, absolutely. Raw intelligence is completely commoditized. 600 people ace the SAT every single year in the U.S. alone. Millions of people across the globe can learn to code or run a complex spreadsheet or write marketing copy. Raw intelligence is no longer a unique, impenetrable advantage.
So what is the advantage? If I can't outsmart the global market, how do I win?
Flexibility. If you have unspent assets, if you have wealth that you intentionally did not spend on a Porsche or a bigger apartment, you have flexibility. Stored wealth is stored autonomy.
Right.
If you have 6 months of emergency expenses sitting in a boring bank account, it means you aren't terrified of your toxic boss.
Yeah.
It means if you are laid off tomorrow, you do not have to desperately accept the very first soul-crushing job offer that comes along just to make rent. You can wait for a good one.
It's the ultimate power in a negotiation. It's the ability to walk away.
Exactly. More wealth means you can afford to take a lower-paying job that you actually love,
Mm.
or a job that teaches you a completely new, highly valuable skill. It means you can take a sabbatical to figure out your life or start a business without risking starvation. When you do not have control over your time, you are forced to accept whatever bad luck is thrown your way. Unspent money is the shield against that bad luck.
So we have to completely radically redefine what the word savings means. Stop looking at savings as deprivation. Stop looking at the money you put into an investment account as fun that you are denying yourself today.
Yes.
Instead, redefine savings as purchasing slices of your future freedom. Every single dollar you save is a point in the future that would have been owned by a boss or owned by a bank collecting interest being handed directly back to you. You are not depriving yourself. You are buying your own autonomy.
You are purchasing the ability to wake up on a Tuesday morning and say, I can do whatever I want today.
That is incredibly empowering.
Hmm.
All right, let's pull all of this together. We've gone from the tech executives skipping gold coins into the ocean to the realization that surviving risk is more important than raw intelligence, to the understanding that true wealth is about buying time.
Right.
And the overarching lesson from all these sources is a slight shift in vocabulary. The goal of managing your money and your career isn't to be coldly, perfectly rational.
No, because we aren't spreadsheets. We are human beings. Aiming to be completely rational works in a vacuum or in a textbook. But humans are emotional, hormonal, status-driven creatures. We make financial decisions at the dinner table based on how to not disappoint our spouses or how to provide security for our kids, not on what maximizes a logarithmic return.
The goal isn't to be rational, the goal is to be reasonable.
Yeah.
It is perfectly reasonable to hold a huge chunk of cash, earning terrible interest, because it helps you sleep soundly at night, even if an economist would tell you it's mathematically suboptimal. It's reasonable to have a barbell strategy where you are terrified on one end and ambitious on the other. It's reasonable to acknowledge that luck and risk are twins and to forgive yourself when things go wrong.
Aiming to be mostly reasonable works infinitely better than trying to be coldly rational, because reasonable is something you can actually stick with for the long run. And as we saw with the Ice Age, sticking with it, just surviving the summer, is what makes the compounding happen.
Before we sign off, I want to leave you with one final provocative thought to mull over. Based on a psychological quirk the sources call the end of history illusion.
Oh, this is a good one.
It is this bizarre cognitive blind spot we all have. We know that we have changed a massive amount in the past. If you look back at who you were 10 years ago, you probably don't even recognize that person. But for some reason, we assume that whoever we are right now is the finished product. We assume we will remain exactly the same person in the future.
We constantly, systematically underestimate how much our goals, our desires, and our values will change over time.
Exactly. Think about the 20-year blocks of your life. What you desperately wanted at 18 is likely not what you want at 38, and it is almost certainly not what you will want at 58. So ask yourself, are the extreme financial and career goals you are sprinting toward right now, all those 60-hour weeks, the stress, the sacrifices, are they built for the person you are today?
Right.
Or do they leave enough room for error, enough margin of safety, and enough flexibility for the entirely different person you are going to become in a decade? Are you trapping your future self in a life they might not even want?
The ultimate goal of building wealth is to protect your ability to change your mind.
Protect your ability to change your mind. Thank you for joining us on this deep dive. Take a breath, forgive yourself for the risks that didn't pan out, and take control of your time today. Because the math won't save you, but your behavior will.